Hello, how are you everyone? This is return overview or the definition of return and that is overview including its component. So in this chapter we will see the return on investment in details. So return is a reward and a motivating force behind every investment. So behind every investment, there is a reward or any motivation. So there is a return. You can say there is a return behind investment. This is common for investment. Investment with or return is netting. It is amount or rate of gain. So the rate of gain that we get from those investment is known as a rate of investment. Or it may be as a profit which occurs to an investment. So that in other way it is the investment that we get from that investment. In finance, rate of return, or we can say in other name, return on investment, rate of profit, or it's also called return. Okay, it's also called a return. Then the rate of return required by a firm to great extent depend upon the risk involved. So, for example, if the risk is high, the return will be also high. Okay, the investors may depend on that risk. Maybe if the risk is very low, our return will be low. So the investors should be select those investments. So return on investment has two components, regular income in the form of, in investment, there are two components, okay? There are two components. So you know that the one is the regular income, or in terms of interest, or in terms of dividend. The other is capital appreciation. That means in the time of price increment, there will be capital appreciation. So there are two components of return on investment. So generally, it is known as capital appreciation or capital gain, and the other one is regular income like interest, dividend, like that. This is very important point that we should have to understand. The component of required rate of return, or there are some components, some other components of rate of return. This is known in financial theory. The rate of return at which an investment rate is the sum of. There are different components. Okay, there are different components of the return. The first one is risk-free interest rate. This is the rate to which all other investments are compared. We compare all other investments on these risk-free interest rates. It is the rate of return an investor can earn without any risk in world with of no. That means let us say when there is no any inflation, so in the world, okay. This is known as risk-free. The other one is inflation premium. This is the rate that is added to an investment to adjust it for the market expectations of the future inflation. Okay, for the future expectations of inflation, we add some amount on investment. Okay, this is premium on investment. Okay, premium means additional amounts on that investment. Okay, by considering the future inflations, by considering the future, this is very important that we should have to understand. The other one is a liquidity premium. This is not thinly traded investments, such as, for example, thinly traded investments such as stocks and bonds are family controlled company require a liquidity premium. That is, investors are not going to pay the full amount of asset if there is a very real possibility that the issue of the bond or the shares the issuer of the shares will not be able to repay in short period of time because buyers are scarce. This is known, okay, because buyers are scarce. So this is known as liquidity premium. This is expected to compensate investors for the potential loss the buyers. The size of the liquidity premium is dependent upon the investor's expectations of how active particular market is. How this is known. So it is depend on that, depend on investors' perceptions, okay, of how active particular market is. The other one is default risk, as we say. Investors believe that the issuer's company will default, unable to repay means, okay, default means unable to repay some amount of money. So on it is an obligation or go to bankrupt when some investment is go to bankrupt, and as a result of investors demanding a default risk premium, this is known, okay. The other one is maturity premium, that is a reward for greater price fluctuations, okay. When interest rate change increase, the maturity period of security increase. Since it is maturity premium, when there is greater fluctuation when the interest rate is changed, there is very large or greater price fluctuations. The other one is measuring return. The return should be measured, okay, measured. So there are some measurements ways. So return on the investment can be seen in two ways. For example, ex post return and ex ante return. Ex post return calculation done after the fact, okay. It is about act after the fact in order to analyze what the rate of return was earned. Ex post return is based on the historical data. Since it is after the fact, it is based on the some historical data that we have before. The other is ex ante return. It is before the fact, okay. Return calculation may be done before the fact, in which the case assumption must be made about the future, okay. Ex ante return forecasted returns for the future time, okay. It is for the forecasting about the future time. This is not based on historical data. So measuring some historical return or ex post return measurement, we will see that measurement of historical rates of returns that have been earned or security or class of security, all as to identify trends or tendencies that may be useful in predicting the future ones of the measurement of. From those measurement, for example, the holding period return HPR. So the simplest measure for return is holding period. It is very simplest measure of the return. So it represents an investors received for holding an investment for a certain period of time. This calculation is independent of the passage of time. Since it is ex post, we use historical data and they incorporate only beginning point and ending point. When we calculate the HPR or holding period return, we use beginning point and ending point. That is why we say it is very simplest measurement. That's very important point. So it is very understandable calculations and it is very easy to calculate. For example, the HPR equal is ending value minus beginning value plus income divided these to beginning value. Ending minus beginning. So from the ending, we should have to deduct the beginning value. If you have other income, we should have to add other income on that. Then you should have to divide this the result to the beginning value. So this is holding return. Or in other way, it is about by deducting the purchase price from the sale price, then adding current income if there is available. Then we should have to deduct divide these to purchase price amount, or in other way, capital gain or loss plus current income or purchase price. That's a very important point. This is holding period return calculation. This is easy, okay? Capital gain or loss means sales price minus purchase. So then we add current income on that. Then we have to divide to purchase price. That's a very important point. It is important to understand that HPR is an ex post return. It is based on historical data, that is return that has already taken place. It is based on the return that has already taken place. So this is historical. It is sometimes known as the historical return. We can say it is based on historical data, because of that it is known as historical return. Okay, it is also historical return. Another thing that you should be aware of, that the HPR is measurement for return of a single trade. It may be for 4 months, for 4 months, for single trade. Let we do some illustration regarding the HPR. Assume Mr. X has purchased, Mr. X has purchased 100 common shares at 25 per share, receives a 10 cents per share dividend, and the latter sell the shares for 30. Okay, he received 10 cents per share dividend, and the latter, Mr. X, sells the shares for 30. What is the holding period for Mr. X? Oh, this is easy, okay? So we should have to multiply 100 by 30. Then we should have to deduct 25 times 100, plus we have 10 cent income on that. 10 cent times 100. This is current income, okay? This is current income. Then we should have to divide the purchase price, 25 times 100. Okay, 25 by 100. Purchase 10 common shares, okay? 10 common shares by 30, okay? That's a very important point. Then later the share was sold by how much? 30. So our formula is capital gain plus current income divided by purchase price, or sales price minus purchase price plus current income. Sales price or sales price is 30 times 100. Okay, so 30. This is okay, ending, okay, sales price ending minus 25 times 100. Okay, that is the beginning purchase price. Okay, purchase price plus income on that. We get 10 cent income on that, so 10 cent times 100. So we should have to divide those by that amount. So our result is 20.4%. Okay, it makes no difference. For example, there is no difference if holding period return is calculated on the basis of single share. You should have to calculate this based on single share also. Okay, based the result is 20.4%. The result is the same. Okay, that's a very important point. Or that means 30 minus 25 plus 0.1 over 25. Okay, the result is the same. Has this investment done well? Has this investment done well? That's the questions. So the answer depends on how much time passed between the purchase and the sales. Okay, the time. Okay, the passage of time is the factor for that, for the investment is well done or not. Assuming their share were required in 2003 and sold in 2013. Okay, the total gain of 2024 is less than what it could have been earned in the bank saving account, which pays 5% current rates. For example, if the stocks were purchased after 2010, the return is attractive. Okay, this is a purpose. We should have to see the passage of time to say the investment is well done or not.